AT&T is a stock beloved by dividend investors. It's been increasing its dividend payout for 36 consecutive years and has been trading at a very tempting 7% starting dividend yield over the past year. The market has been discounting the company based on its large debt, business segments in decline, and bad investments such as DirectTV. However, its core wireless and internet business are steady cash cows, and they have room to grow into an entertainment powerhouse through WarnerMedia and their new streaming service, HBO Max. In this video, I'm going to analyze AT&T's entire business and explain why it's one of the largest holdings in my long-term dividend stock portfolio. My name is Zach. You should leave a like and subscribe to the channel if you enjoyed the video. You should never invest in a business you don't understand, so today I'm going to provide a full picture look at the business and stock history of AT&T. It was originally founded as the Bell Telephone Company by Alexander Graham Bell in 1885. It then became known as the American Telephone and Telegraph Company and was shortly later rebranded to the name we know today, AT&T. The company grew to a massive size and dominated the phone service industry across the United States and Canada. However, all this success did not come without its problems, as public concerns mounted over them being a monopoly. In 1982, U.S. regulators broke up the AT&T monopoly, requiring them to divest from their regional subsidiaries and turning them each into individual companies, commonly referred to as baby bells. Over the next few decades, these companies would begin to develop and merge together. Today, AT&T, Verizon, and Lumen Technologies are the companies controlling these subsidiaries, with AT&T being the largest of the group. So what does AT&T's business look like today? It can be broken down into three main segments: AT&T Communications, WarnerMedia, and AT&T Latin America. AT&T Communications is the largest part of the company at $138.9 billion in revenue, which is 80.8% of their 2020 total revenue. This segment is broken into mobility, video, broadband, and business wireline. The mobility unit provides nationwide wireless to consumer, business, and wholesale subscribers located in the United States. In 2020, it earned $72.5 billion in operating revenue, which is a 1.4% compound annual growth rate since 2018. The total mobility subscribers are at 182.5 million, which is a 9.6% compound annual growth rate since 2018. Mobility provides a consistent stream of recurring revenue through its subscriptions. This allows AT&T to reliably plan and invest around this income. You'll notice that the subscription model is something that's present in all of their business segments and helps make the cash-generating machine that is AT&T. In July 2020, they launched their 5G wireless network nationwide, and they claim that it's the fastest in the United States. The video unit provides more traditional TV subscriptions and sells advertising. This segment has been declining in recent years due to the trend of cord cutting. In 2020, it earned $28.6 billion in revenue, which is a negative 7.9% compound annual growth rate since 2018. Total connections are at 17.1 million, which is a negative 19.5% compound annual growth rate since 2018. They are innovating and trying to hold on to this segment since it has historically generated so much revenue. The rise of streaming services has really pressured traditional cable companies to step up their game. It's kind of sad this segment is declining because the current product offering is radically better than cable used to be. The new AT&T TV is actually more comparable to streaming boxes like Apple TV, Roku, etc. There's no satellite dish, no cable box, and no appointments. You can set it all up yourself just by plugging it into the TV and connecting to the internet. It combines the best of both worlds as you get the live TV, on-demand, cloud DVR recordings, and over 7,000 apps. This allows you to easily watch streaming services like Netflix, Disney+, and of course HBO Max. So not only is it a streaming box of its own, but you can actually watch AT&T TV on other streaming devices like Apple TV, Fire TV, Roku, and as apps on both iOS and Android. So AT&T TV is actually kind of a streaming service of its own. Also, there's still the benefit here for live content content and especially with sports. Traditional TV has really improved, but it's still flawed in comparison to streaming services. It's expensive and forces you to pay for a bunch of content you may never watch. Just look, the cheapest option is $59.99 a month. Now as an investor, that sounds awesome, but as a consumer, that's a lot when you also factor in you're likely paying for Netflix, Disney Plus, and other streaming services. So when I think about where this is going, there are a lot of unknowns. I like that they're innovating their product offering, but it seems like we're moving towards consumers picking exactly what channels and services they want to pay for. The broadband unit of AT&T provides internet and legacy telephone services to residential customers. In 2020, it earned $12.3 billion in operating revenue, which is a negative 3.15% compound annual growth rate since 2018. The high-speed internet section is the largest portion and is steadily growing at a 3.5% compound annual growth rate. In 2020, it earned $8.53 billion in operating revenue. However, the legacy home voice plans are what's dragging down this segment. In 2020, this generated $2.3 billion, which is a negative 17.2% compound annual growth rate since 2018. Over the next few decades, I expect the legacy home telephone will continue decreasing until it's practically nothing. The business wireline unit provides advanced IP-based services as well as traditional voice and data services to business customers. In 2020, it earned $25.3 billion in operating revenue, which is a negative 2.6% compound annual growth rate since 2018. The strategic and managed services section earned $15.7 billion in 2020, which is a 3.8% compound annual growth rate since 2018. This is made up of data services, including their VPN, dedicated internet, Ethernet, and broadband, voice service, including VoIP and cloud-based voice solutions, security and cloud solutions, and managed professional and outsourcing services. I expect this will continue growing into the future. The business legacy voice, similar to residential, is causing this segment to decline. In 2020, it earned $8.1 billion, which is a negative 14.2% compound annual growth rate since 2018. I expect this to continue declining, but I think it has much more long-term application than its residential counterpart. The idea of an office phone does make sense in some cases. So that wraps up AT&T Communications, which provides the lion's share of the company's revenue. Aside from the declining sections I mentioned earlier, the core mobility and internet business is protected by a wide economic moat. This aspect of the business requires a large infrastructure, which AT&T has been building for decades and decades. The capital, time, and energy needed to compete gives AT&T a large competitive advantage. On top of this, the telecommunications industry is heavily regulated, which adds more barrier to entry. The subscription business model creates a reliable cash flow for the company. Also, the wide array of services they offer allow them to bundle and provide the customer a better value, giving them cost advantages against competitors. For example, they often offer their internet and TV packages together, which is a better value than them separately. Also, if you notice on almost every AT&T subscription, they are offering one free year of HBO Max, which is their new streaming service we're about to discuss. WarnerMedia is the second largest part of AT&T at $30.4 billion in revenue, which is 17.7% of their 2020 total revenue. In 2018, AT&T acquired Time Warner for $108.7 billion after they won an antitrust lawsuit. Shortly after the acquisition, Time Warner was rebranded to WarnerMedia. This segment is broken into Turner, Home Box Office, and Warner Bros. Turner offers multi-channel basic television networks and digital properties. They also sell advertising on their networks and digital properties. In 2020, it generated $12.5 billion in operating revenues. 60.5% of that revenue came from cable subscriptions, 31.3% from advertising, and 8% from content and others. Home Box Office, or HBO, consists of a premium pay television service and HBO Max, which launched in 2020. It ended 2020 with more than 41 million HBO Max and HBO subscribers in the United States and nearly 61 million globally. They recently raised their target for future subscriber growth. More on this later. In 2020, it generated $6.8 billion in operating revenues. 89.4% of this comes from subscription revenue. Warner Bros. Consists of the production, distribution, and licensing of television programming, feature films, and games. Operating revenues decreased in 2020 primarily due to movie theater closures and television and theatrical production delays. It earned $12.1 billion with 50.7% from television, 36.2% from theatrical, and 13.1% from games. The strength of WarnerMedia comes from the iconic brands and franchises they own. Warner Bros., HBO, TBS, TNT, truTV, CNN, HLN, Boomerang, Cartoon Network, Adult Swim, Cinemax, DC Comics, and much, much more. HBO brings shows like Game of Thrones, Curb Your Enthusiasm, Westworld, Silicon Valley, The Sopranos, and Succession. New shows of top-notch quality are constantly in development. Cinemax, TBS, TNT, and truTV have access to a myriad of movies and shows, as well as unique original programming. Warner Bros. Has created blockbuster films like the Dark Knight trilogy, Joker, Tenet, Inception, Harry Potter, The Matrix, Godzilla, and Lord of the Rings. All of these entities give WarnerMedia a large catalog of high-quality shows, movies, and iconic entertainment brands that provide massive value to AT&T. An economic moat is formed by decades of brand building among many of these properties. In the age of streaming services, content ownership is key. That is why I think HBO Max is set up to be one of the top video streaming services. They announced that they will be launching all new Warner Bros. Films simultaneously in theaters and on HBO Max. This is going to result in increased adoption of the service. They already saw a subscriber uptick from the release of Wonder Woman 1984. More recently, they just released Zack Snyder's Justice League, which has gotten rave review from fans. I imagine this will lead to huge signups for HBO Max since it's fully exclusive to the service. New blockbuster films are going to keep coming. Just imagine when a new show at the same caliber of Game of Thrones is released. It's over then. Game, set, match. Just from early data, even after a slow launch, AT&T raised their subscriber target, now saying that HBO Max will reach 120 to 150 million global subscribers by 2025. In the long run, I think that they are going to be third place in the streaming wars behind Netflix and Disney+. In my view, the main thing currently plaguing the service is price. It's $14.99 a month, which is more than both Netflix and Disney+. Being the new kid on the block, they really should have followed Disney's model of a low price to try and amass as many subscribers as possible. However, HBO Max was flawed in that they couldn't make it cheaper than the existing HBO channel. They are trying to transition people away from the legacy HBO. Everyone who already pays for HBO gets HBO Max for free. Luckily, they have been thinking about the price problem. In 2021, they are going to launch an ad-supported version of HBO Max. This will be available at a lower price. Additionally, they are going to expand availability to areas outside the United States. In June, HBO Max will expand to 39 countries and territories across Latin America and the Caribbean. All this will continue to fuel more HBO Max growth. AT&T Latin America is the smallest part of AT&T at $5.7 billion in revenue, which is 3.3% of their 2020 total revenue. The Latin America segment provides entertainment and wireless services outside the US. Its business units are Vrio, which is a satellite-based video service, and Mexico, which provides wireless service and equipment to customers in Mexico. Vrio is 55% of operating revenue, while Mexico Wireless is 45%. Although AT&T Latin America is small and less developed than its North American counterpart, it has potential to serve as an expansion of AT&T's business in the long run. So that should give you a good understanding of AT&T's current business. Now let's take a look at some of its fundamentals. But first, a word from our sponsor. This video is sponsored by SkillShare. In order to be successful in both life and investing, you need to become a lifelong learner. SkillShare is a platform that can help you do just that. Join an online community with thousands of classes for creative and curious people. Explore new skills, deepen existing passions, and get lost in creativity. Pick from a wide array of topics such as graphic design, web development, animation, marketing, photography, and entrepreneurship. Let's say you want to start building a side business to increase your income. Well, then check out a class like Building an Etsy Shop That Sells, Strategies for E-Commerce Success by Parker Gard. This will teach you how to create an e-commerce store on Etsy, develop a product, build a brand, and increase discoverability. A lot of these principles are universal and will apply to all different kinds of e-commerce stores. SkillShare is curated specifically for learning, meaning there are no ads, and they're always launching new premium classes so you can stay focused and follow wherever your creativity takes you. And it's less than $10 a month with an annual subscription. But luckily, the first 1,000 of my subscribers to click the link in the description will get a free trial of premium membership so you can explore your creativity. Now let's get back to the video. Since we just analyzed the company by its 3 segments, let's take a look at the financial results of those segments. For revenue, communications decreased from $143.7 billion in 2018 to $138.8 billion in 2020. This is a negative 1.7% compound annual growth rate in this segment. WarnerMedia increased from $20.5 billion in 2018 to $30.4 billion in 2020. This is a 21.6% compound annual growth rate. Latin America decreased from $7.6 billion in 2018 to $5.7 billion in 2020. This is a negative 15.7% compound annual growth rate. The operating contribution of each segment followed similar trends. Communication decreased from $32.1 billion in 2018 to $30.52 billion in 2020. This is a negative 2.5% compound annual growth rate. WarnerMedia increased from $7 billion in 2018 to $8.2 billion in 2020. This is an 8.1% compound annual growth rate. Latin America decreased from negative $710 million in 2018 to negative $729 million in 2020. This is a negative 1.3% compound annual growth rate. Now let's take a look at AT&T's business as a whole. Over the last 10 years, the revenue grew from $124.28 billion to $171.7 billion, giving it a 3.2% compound annual growth rate. Their gross profit grew from $74 billion to $91.8 billion, giving it a 2.1% compound annual growth rate. Their net income has varied a great deal with an overall trend upwards. However, their 2020 net income was actually negative $5 billion. This was due to a $15.5 billion impairment charge from their investment in DirectTV. This was a terrible investment and one of the company's worst management decisions. In 2015, they bought DirectTV for $49 billion. It has been declining since its purchase, and luckily AT&T was able to sell off some of the ownership recently. In early 2021, they sold a minority stake to the equity firm TPG for $7.8 billion, which now values DirectTV at roughly $16 billion. AT&T and TPG will create a new joint venture where they will try to create as much value as they can from the service. This DirectTV debacle is hopefully behind them now, and impairment charges won't get in the way of positive earnings. But now, we need to take a look at the stock as a dividend investor, since that's the theme of this channel. It has a $2.08 annual dividend payout, giving it a 6.86% dividend yield at its current price. The dividend has a 1.96% 5-year compound annual growth rate and has been consistently increasing for over 36 years. Now you may be thinking, how are they supporting this dividend if they just had negative earnings? Well, their 2020 free cash flow per share is $3.84, which is well above their annual dividend per share. The earnings were made negative from the one-time impairment charges that we discussed earlier. In the recent annual report, AT&T CEO John Stankey said that we are committed to supporting the dividend. My confidence in saying that comes from the financial strength and flexibility provided by the $27.5 billion in free cash flow we generated in 2020 and the $26 billion we anticipate this year. Our strong cash generation in 2020 allowed us to finish the year with our full year dividend payout ratio at 54.5%. A very comfortable position. End quote. AT&T is a cash-generating machine and will be able to continue paying and slowly increasing its dividend for a long time to come. The starting dividend yield has been hovering around 7% this past year, which is historically high for the company. When you also take a look at the 9.63 forward PE ratio, AT&T seems to be an undervalued stock in today's highly valued market. Another major concern for investors about AT&T is their debt. In absolute terms, they have a staggering amount of debt. $153 billion in long-term debt, and $346 billion in total liabilities. However, AT&T has an insane amount of assets at over $525 billion, so they actually have a significant shareholder equity. You also need to take into account that AT&T generates huge and reliable amounts of cash. In their recent annual report, they said they're expecting 2021 free cash flow of around $26 billion, with a dividend payout ratio in the high 50%. After they pay dividends, they're expecting to use free cash flow dollars to pay down debt. Barring some catastrophic scenario, AT&T will continue paying down its debt while maintaining their dividend and investing in their business. Also, thanks to the low interest rate environment, AT&T has been able to restructure some of their debt, making it easier to service. I'm going to link in the description a Seeking Alpha article that goes into heavy detail about their debt if you want to read more about it. Another thing to remember is that AT&T isn't a very capital-intensive business. It requires huge investment in infrastructure. Most telecom companies have very similar levels of debt. Just look at Verizon. It also has significant levels of debt as well. I've taken the last year to load up on AT&T at a great starting dividend yield. It's currently my largest position by cost basis in my long-term dividend stock portfolio. Currently, I have 224.57 shares of T with a dividend yield of 7.29%, compounded yield of 7.52%, and a cost per share of $28.49. So in total, I have $6,212 invested in AT&T. My plan is to buy more T when it's around my average cost. It's certainly a mixed bag with some declining segments and a slow turnaround story for growth, but the strong cash flow and dividend are enough to get me on board at this price. However, don't take my advice blindly and be sure to do your own research before making any investment decisions. Thank you for watching Dividend Data. I'd greatly appreciate if you could leave a like and subscribe to the channel. If you follow me on Twitter, link in the description, you can get real-time updates of my buys and dividends coming in. Also, you can follow me on Instagram at Dividend Data, where I've been posting frequently. You can support the channel over on Patreon, where you can gain access to a community Discord server. The link is in the description. Please leave a comment below, and thank you for watching.